On December 30th, 2025, the silver market didn't get volatile. It got exposed. The Chicago Exchange jacked up silver margins by 50% in 7 days, and it wasn't because of war or a bank blowup or some headline you saw on your phone. It was because too many people asked a simple question. Cool, where's the metal? That week, physical delivery requests surged so hard that tens of millions of ounces were spoken for in a handful of sessions. Paper traders were staring at a chart sliding from the mid-80s back towards 70, thinking the party ended. Meanwhile, industrial buyers did the exact opposite. They came back in 48 hours and started shopping like the shelves were about to go empty. Because for them, this isn't a trade, this is oxygen. And once you see that, you realize what actually happened. The silver market just signaled a supply panic without admitting it. Now watch this. We're going to treat this like grown-ups. Facts first, then interpretation. This is educational. We manage risk. Fact. Raising margin that fast is a pressure valve. It forces weak hands to dump contracts so the exchange can slow the stampede. Interpretation. When an exchange needs a pressure valve, it's telling you the system is tight somewhere you can't see on a candle chart. So what tightened? It wasn't one thing. It was a chain reaction. And the first domino is solar. For years, solar panels were a steady, predictable sip of silver. You could model it. You could forecast it. It was the boring part of the spreadsheet. Then the industry chased efficiency like it was life or death. And in solar, it basically is. A newer cell design grabbed market share fast, and it changed the silver math. Older panel tech used a small amount of silver per watt. The newer dominant design uses a lot more silver per watt because it needs high-quality electrical contacts in more places. That sounds like a nerd detail. It's not. It's the difference between silver being an ingredient and silver being the bottleneck. If we're wrong, where will it show first? It shows in inventories. It shows in premiums. It shows in borrowing costs for physical metal. It shows in delivery behavior. And that's exactly where the trail leads. Let's keep it simple. When solar companies change a manufacturing recipe, they don't care about your spot price chart. They care about output per square meter and who wins the next gigawatt contract. If silver is the only thing that keeps efficiency high enough to win, they buy silver. Period. Now add the second domino, scale. Global solar installations have been ripping higher, and the world is trying to electrify everything at once. Homes, cars, factories, data centers. So demand isn't rising in a straight line, it's stepping up. And the mistake most people make is they look at demand like a calm river. This isn't a river anymore. This is a dam that's cracking. Because while solar is gulping more, supply isn't responding like oil supply responds or copper supply responds. Silver is weird. Silver is stubborn. Silver doesn't come out of the ground because silver feels like it. Most silver is produced as a byproduct. It rides along with other metals. That means higher silver prices don't instantly create a flood of new silver. They create a trickle. Fact. It takes years to build a mine, and most silver comes out of copper, lead, zinc, and gold operations. Interpretation. Even if the price screams higher, supply can't sprint. It can only limp. So what happens when demand starts sprinting? We drain stockpiles. And that's the part nobody likes to talk about because stockpiles are the safety cushion that keeps the market looking normal, right up until it doesn't. Here's the key distinction the paper world hopes you never internalize. Warehouse reports show eligible metal and registered metal. Eligible means it exists in the building, but it's owned by someone who hasn't volunteered it to settle contracts. Registered means it's actually available to deliver. One is metal that exists. The other is metal you can legally force into your hands. Do you see the trap? When people say there's tons of silver in vaults, they're usually pointing at eligible metal. But if that metal isn't for sale, it's not supply, it's a museum exhibit. And registered inventories, deliverable inventories, have been collapsing for years. Not gently, violently. We're talking about a drawdown so severe that the exchange now has a buffer that looks like weeks, not months, against global industrial consumption. That's not a market. That's a hostage situation. Now, here's the part that should make you sit up. If you're a solar manufacturer, you don't care that a futures contract says 5,000 ounces. You care if the metal arrives on schedule, in spec, in the right form, through the right refinery chain. Because if the metal doesn't show up, your production line doesn't run slower. It stops. And a stopped production line doesn't cost you a little profit. It costs you contracts, market share, and your job. So what do rational industrial buyers do when they sense the exchange might not be the most reliable grocery store anymore? They bypass it. They start calling miners and refiners directly. They sign multi-year agreements. They pay premiums. They hoard working inventory, not because they want to speculate, because they want to survive. This is where the market quietly splits into two worlds. World one is the screen price. That's the price you and I see. It's liquid. It's tradable. It's the headline. World two is the delivery price. That's what big buyers pay when they need guaranteed metal on a schedule. And when those two prices diverge, you're watching the paper market lose authority in real time. If spot price is stable, why are physical premiums climbing? If the market is well supplied, why are lease rates exploding? If nothing is wrong, why are margin requirements being slammed higher to slow delivery pressure? You already know the answer. Now let's talk about the December delivery shock. Within days, a huge chunk of deliverable metal was claimed. That's not normal behavior in a calm market. That's behavior you get when someone, somewhere, doesn't trust future availability. And the exchange's response, raising margins hard and fast, did what it's designed to do. It punched retail speculators in the face and shook out leverage. But here's what it did not do. It did not add new ounces to the planet. It did not create new refining capacity. It did not change the fact that solar, electronics, and infrastructure still need silver tomorrow morning. That's why the industrial bids came right back. Because margin rules don't change physics. And physics is what we're really talking about. Silver isn't just shiny money. It's the best electrical conductor in the periodic table. It's the metal you use when you can't afford heat, resistance, or inefficiency. That's why it shows up everywhere the modern world cares about. High reliability contacts, fine circuitry, high efficiency photovoltaics. So when the world tries to build a clean energy future at scale, silver becomes structural, not decorative, structural. And structural demand has a nasty personality trait. It's inelastic. If you're building a panel line designed for a certain process, you can't just swap a critical material overnight because the price moved. You can try to thrift it. You can try to shave grams. But you can't cheat the electron. If you reduce silver too far, efficiency drops, failure rates climb, warranties explode, and your competitor eats your lunch. So yes, engineers will reduce silver intensity over time. And no, it won't save the market in the near term if volume keeps rising. That's the volume override effect. The industry gets more efficient while total consumption still climbs because factory output keeps compounding. Now pause and ask yourself a dangerous question. What happens when industry stops trusting the spot market and starts locking up supply years in advance? The float shrinks. The remaining metal becomes the marginal ounce, and marginal ounces set marginal prices. That's when price starts moving like a loose power line in a storm. You get flash drops, flash spikes, violent squeezes, violent shakeouts, not because fundamentals change daily, but because the tradable pool is thin, and that's why margin hikes matter so much. Margin hikes don't just cool speculation, they prevent a run on the vault. They slow the speed at which paper claims turn into physical demands. They buy time. But buying time is not fixing the problem. It's admitting you have a problem. Now let's drag London into this. London is the big over-the-counter hub. But deep is not the same thing as available. A lot of vaulted silver is spoken for. ETFs, long-term holders, private allocations. So the number that matters isn't how much metal exists behind doors. The number that matters is how much metal is floating, lendable, deliverable, and willing. And one of the cleanest tells in that market is the lease rate. A lease rate is what you pay to borrow physical silver for a short window. In a normal world, it's low, single digits, boring. When it spikes, it means someone is paying up for immediacy. It means metal is scarce in the time frame that matters. And when you see extreme borrowing costs, you're looking at fear disguised as math, because the borrower is saying, I don't care what it costs, I need the metal now. And the lender is saying, I'm not sure I can replace it later. That's not a healthy commodity market. That's a lifeboat economy. Now add Asia. Asian physical markets don't treat silver like a casino chip. They treat it like feedstock. When demand spikes, premiums show it, inventories show it, and flows shift fast. When Asian inventories dip to thin buffers and the West is simultaneously draining registered supply, you get a global game of musical chairs. And here's the cruel part. There aren't enough chairs. And there's another choke point most people ignore. Refining and export gates. Silver isn't useful to a factory as some metal somewhere. It has to be refined, certified, shipped, and timed. When major producing regions tighten export rules, or when refiners prioritize their biggest clients, the spot market doesn't run out. It just gets starved. That's when you see the quiet premium ladder. Small buyers pay spot plus a little. Mid-sized buyers pay spot plus a lot. The giants don't even ask for spot. They ask for guaranteed tons, guaranteed dates, and they pay whatever clears the schedule. Fact, premiums exist when certainty is scarce. Interpretation, a rising premium is the market screaming, even if the screen price is whispering. So if you only watch the chart, you'll miss the real auction happening off screen. Behind NDAs and procurement meetings with contracts that lock up next year's metal before you even hear the rumor for good. So what happens next? We get a two-tier system that becomes permanent. Paper settles in cash, physical trades by negotiation. And the gap between cash settlement price and real delivered metal becomes the new battlefield. This is where people get hurt, and this is where people get rich, depending on whether they understood the structure before the headlines arrived. But we're not here to hype. We're here to measure. So let's separate what's clear from what's possible. Clear? Demand from electrification and high-efficiency solar is structurally strong. Clear? Supply response is slow because silver is largely byproduct production. Clear? Inventories that matter, deliverable inventories, have been draining. Likely, industrial buyers will keep moving off exchanges and into direct contracts. Possible. An exchange could face a delivery stress event where it encourages, delays, or forces cash settlement. And if that happens, the psychological shift will be bigger than the price shift. Because the moment the market learns that delivery isn't guaranteed, every contract gets repriced in the mind. That's the real default. A trust break. Now, let's talk about your edge. Most people watch candles. We watch bottlenecks. Most people argue about whether the price should be 70 or 80. We ask, who can still get the metal at all? Because in a shortage, the question isn't what's the price. The question is what's the availability? And when availability becomes the premium, price becomes a footnote. This is why you saw industrial buying return so fast after the smash. Retail got scared by the chart. Industry got scared by the shelf. Now here's the contradiction that's going to confuse a lot of viewers in 2026. You can have falling spot prices and rising physical tightness at the same time. Margin hikes trigger forced selling of paper. Paper sells off. Spot drops. But physical demand doesn't disappear. So premiums rise, lease rates stay elevated, inventories keep draining, and the gap widens. That gap is the tell. That gap is the message. And the message is the screen price is not the whole market anymore. Now, what do we do with that? First, we stay sane. This is educational. We manage risk. We don't use leverage like a lottery ticket. We don't pretend the market can't punch us in the face for months. But we also don't ignore a structural story because the chart had a bad week. Second, we watch the real signals. We watch registered inventories, not total inventories. We watch lease rates. We watch physical premiums. We watch whether big buyers keep signing multi-year offtakes. Because those are the metrics that tell you if the market is healing or tightening. Third, we stop believing comforting narratives. Recycling will save us. Maybe later. But recycling doesn't respond next month, and a lot of silver is dispersed in tiny quantities that aren't economical to recover quickly. Mining will ramp. Maybe later. But a mine is a decade-long project, and byproduct metals don't respond on command. So near term, the buffer is inventory. And we're burning that buffer. Now I want you to think about the phrase day zero. Day zero isn't the day silver hits a certain price. Day zero is the day a manufacturer can't get metal in time and a production line goes dark. That's when procurement departments panic. That's when contract premiums explode. That's when the paper price starts looking like a joke. And that's why December 30th mattered. It was a warning flare. The exchange didn't say, we're short of metal. It said, here's a margin hike. Same message, different packaging. So let me ask you a question that forces honesty. If silver was abundant, why did they need to slow delivery behavior with an aggressive margin hammer? And if this was just volatility control, why did industrial buyers return immediately, like they were buying food before a storm? Now, here's the one place people will get tripped up. They'll assume the story guarantees a straight line up. It doesn't. In tight commodity markets, price action becomes warfare. Volatility is used to shake out anyone who can't hold their position through chaos. So yes, you can still get violent sell-offs. And no, those sell-offs don't automatically invalidate the structural squeeze. If we're wrong, where will it show first? It'll show in the real-world signals cooling off, inventories stabilizing, lease rates normalizing, premiums collapsing, industrial offtakes slowing. Until then, the market is telling you it's tight. Now, here's the cliffhanger that matters. If exchanges are the public scoreboard and industry is walking away from the scoreboard to do private deals, what happens to the scoreboard? It becomes less representative. It becomes easier to push around with paper. It becomes more volatile, and it becomes more dangerous as a reference point for people who think it still reflects the whole physical world. That's the setup for a default without a bankruptcy filing. A default of confidence, a default where the exchange still exists, but delivery becomes a negotiated exception, not the rule. And if that happens, the pricing center of gravity shifts toward physical hubs, toward whoever has metal, not whoever has the loudest chart. So here's what we do next. We keep our eyes on the vault data. We keep our eyes on premiums. We keep our eyes on the borrow market. We don't let one scary red candle rewrite a multi-year inventory drain. And we don't let a comforting narrative hide a simple arithmetic problem. Because at the end of the day, this is just math. Demand is climbing, and supply is slow. Inventories are finite. And the world is trying to build a future that is literally wired with silver. Now, if you want us to keep tracking the signals that actually matter, not the noise, hit subscribe. Short, simple. Do it now so you don't miss the next data drop. And I want you in the comments on this one. What do you think breaks first? The paper price mechanism or an industrial supply chain that can't afford to stop? And if you were running a factory that needs silver every day, would you pay a huge premium for guaranteed delivery or gamble on the screen price and hope the truck shows up? Because the next move in this story won't be announced on a chart. It'll be announced by what disappears from the vault reports. And when that happens, the market won't ask for your opinion. It'll ask who has the metal. And that's when day zero stops being a title and becomes a date.